Okay. Happy New Year to everyone. Welcome to Innovation Works January Roundtable on Accounting and Taxation for Small Businesses. I'm John Springer, Innovation Works Mentor Manager. I think I know most of you. Our presenters who will share more detail about their backgrounds in a moment are from the very highly regarded Baltimore-based accounting firm of Gross Mendelsohn Associates, or GMA. Representing them today are Chris Wehner, CPA and CFP, which let's see if I can say that easily and quickly, certified public accountant and certified financial planner, and Kevin Brady, CPA, certified public accountant. Chris is manager in GMA's tax department, while Kevin is manager in auditing and accounting. And also joining us is Lisa Carmichael, GMA's director of business development. Our audience today, that is each of you, is made up of community leaders, meaning a terrific mix of entrepreneurs, mentors, and Innovation Works staff. As you know, together, we seek to address Baltimore's race and wealth divide through social entrepreneurship, neighborhood strategies, and strategic initiatives. Founded in 2017, in part through the leadership of Jesuit communities and institutions, and in partnership with Santa Clara University's Miller Center for Social Entrepreneurship, businesses spanning multiple developmental stages participate through 4-day boost workshops, 6-month-long accelerators, investment pitching showcases, multifaceted mentoring, and direct capital investment through Ignite Capital. All of you know that very well, I'm sure. Our format today is that I will hand things over to the GMA team. Chris and Kevin will make their presentations. Your questions of a general and public nature should be put in the chat. And thanks to everybody who already submitted theirs in advance. But all questions are welcome today. Please use the chat. Questions of a private and confidential nature can be emailed to me, and I will put my email address in the chat for that purpose. Following the presentations, we will address questions. To honor everybody's time, and we will finish for sure by 1 p.m., we will limit speaking time to the presentation team and ask all participants simply to use the chat for comments and questions. And I hope everybody is okay with that. And then also, I hope that everyone will also feel very welcome to follow up afterwards with me or any member of the Innovation Works team with questions or comments or feedback. With all of that, please welcome Chris Wehner and Kevin Brady. Thanks to each of you meaning everyone on this call, for your great work in Baltimore. And please do feel free to reach out following to me or any member of the Innovation Works team. Chris, on to you.
Thank you very much. So Kevin and I are going to talk to you today about small business finances and accounting and those sorts of things. I'm going to go quickly through our introduction. I've been a manager at Gross Mendelsohn for about 5 years. I've been in public practice for about 18 years. And a lot of my clients are small businesses, individuals, business owners, and I help them with financial planning, tax planning, accounting related situations, and wealth management. And Kevin is a manager in our attest section, and he has experience with manufacturers, specifically breweries, and is very knowledgeable with those sorts of issues with those sorts of companies. So the thing we want to do today, and I appreciate all of the questions that were submitted already, is to have an interactive discussion with you about what you need to learn and know when you're starting a small business in Maryland. We want to have interaction between us and yourselves with the chat functions. If there's anything that's unclear or you'd like to have us emphasize, again, please do so through the chat function. And we want to make sure that you get a takeaway, something that's new, something that you're taking away from this seminar that you didn't know before. Our first thing that we're going to do is go through an introduction on financial and accounting best practices and the different types of entities that are available. Next, we're going to go through some accounting terminology and bookkeeping and how to maintain your financial records to make sure that you're staying compliant with the various government agencies, state of Maryland, Treasury, US IRS, all those guys that we love to deal with so much. We'll also be explaining what taxes you need to be aware of, how those taxes are calculated, and what Kevin and I can do as CPAs that can help you out with your small business. So the first thing that I want to go through is set a foundation to understand what accounting is. And accounting is the process of recording financial transactions for your business. And another way that you can think about what accounting is, it's categorization within the rules of everything that you do for your business. And a good accounting system is going to be able to tell you, as the business owner, how your business is doing, what the trends are, so that you can make the management decisions that you need to make sure that you're executing your strategic vision, your mission statement, and making sure that your business is profitable. So there's a couple of different ways that you can start out and organize and create your business. The first is called a sole proprietorship. And this is the default entity that is owned by a single person. One person owns this business. And for tax purposes, you will file what is called a Schedule C when you file your individual personal income tax return. The second type of entity that is available is what is called a pass-through entity. And there's two types of pass-through entities. One is called a partnership, and one is an S corporation. And these entities are completely separate from their owners, and they, for all intents and purposes, do not pay income taxes in and of themselves. What happens is that the income from these two organizations passes through so that the owners pay the tax at the individual level. A partnership is the default entity type that's owned by more than one person. And an S corporation is a type of corporation that can be either owned by one or more than one person. And the rules about who can be an owner of an S corporation are a little bit more limited than who can start a sole proprietorship or a partnership. And by and large, there's not a whole lot of difference between a partnership and an S corporation as far as what is considered income and what is considered a deduction. For the most part, if a partnership is going to have $100 of income for a year, the S corporation will most likely also have that same amount of income. So a lot of the differences between these entities is administrative and related to the ownership, who can own them, and those sorts of differences. The third type of entity is a corporation. So the first three, they don't really pay any tax at their levels. The biggest difference with a corporation is that not only is it separate from its owners, but it will also pay a tax. And so if a corporation is organized and I am 100% owner of a corporation, and that corporation makes $100 for a year, that corporation is going to pay tax of, call it $20. But I, as the owner, haven't seen any financial benefit from that corporation yet. I need to pay myself possibly a salary, or the corporation can distribute a dividend to me. But that's the main difference between the first three types of entities and a corporation, is that the ownership is a little bit different, and it's differently structured so that who can get the benefit of the ownership of that company. I wanted to make sure that I addressed LLCs. LLCs are a type of ownership, but the way that they are taxed can be varied. They can be taxed as a sole proprietor. One individual can set up an LLC, and it's taxed as through a Schedule C, as like a sole proprietor is. An LLC can also be taxed as either a partnership, or it can be taxed as an S corporation. And the main benefit from forming an LLC is to shield the owners from personal liability. It's not mainly structured as a tax motivated idea. And so now Kevin's going to talk to you a little bit about the fundamentals of a bookkeeping system and what you need to know as far as accounting for the transactions in your business.
Thanks, Chris. Excuse me. As Chris mentioned, my name is Kevin Brady. And so the idea of this accounting fundamentals is whether you are keeping the books yourselves or you're paying somebody to do it as business owners. Understanding the fundamentals of accounting is very important when you get into reporting, assessing your profit and loss statements, looking at your balance sheet and stuff like that. So the first thing we're going to go through is double entry accounting. So the concept for accounting is that for every positive number, you have to have a negative number. So Chris, if you want to transfer over. So for instance, when you perform a service, you get in this example, you would get $1,000, right? That would 1,000 would go into your cash. A revenue is a credit account, so it would always have a negative balance. Kind of counterintuitive, but that's just kind of how accounting works. So cash is a positive number. The negative number to offset making everything zero would go to revenue. Another example would be paying an expense. Rent, if you were to pay money out, that would be a negative number to your cash balance. And then counterintuitive again, expenses are always shown as positive numbers. So the alternative to the negative 200 or the opposing number would go to your cash balance or your rent expense balance. Purchasing computers. So there's a concept of fixed assets. When you purchase something that has a long life, that stays on your balance sheet. So when you purchase something, you obviously will spend cash, which is the negative number, and the positive number would go on your balance sheet as an asset. Additionally, if you weren't going to capitalize this, it would go to an expense account, again, with a positive number. So the concept is always that any entry you make is offset a positive and a negative number to always bring to zero. So that's why accounting is at its simplest level very easy, because if you have any difference, you know there's a problem. Everything should come down to zero. We'll move into the balance sheet. There's three aspects of a balance sheet that you should be aware of. You have your assets, which are cash, computers, fixed assets. You could have cars, equipment, stuff like that. Then you come down to your liabilities, which would be debt, payables, other things that you owe people, and then equity. Equity is two parts. Equity is what you've contributed as an owner into the company, also taken out of the company, and then any income that you've earned over the years, as well as the losses. So your income and your losses build up in the equity account, as well as how much you've put in and taken out. So there's a couple aspects to the equity account. Oh, Chris, if you could go back one slide. And so you'll see here again, your total assets should always equal your total liabilities and equity. Again, everything zeroes out. So kind of keeping with the trend. So we'll move into the income statement next. You have two aspects. Obviously, you have your revenues and your expenses. Although this slide doesn't represent it. As we discussed earlier, your revenues are actually a negative number and your expenses are a positive number. It'll get you down to your net income. Your net income at the end of the year will roll into your equity. So when you close out your year books, it will go from the income statement into your equity number on your balance sheet. So there's two ways that you can elect to do accounting. One is the cash basis and the other is the accrual basis of accounting. Cash is pretty self-explanatory. It's basically just the concept of money coming in and out of your checking account. Whenever you write a check, whenever that check is cashed, that's when you record the transaction. When money comes into your account, you would also show that transaction at that point in time. The accrual basis is a little more work. You basically determine when obligations are fulfilled. So if you, for instance, are selling something to somebody and the agreement states that the revenue that you will have completed your obligation when they receive that widget or whatever you would like to call it, when the shipping documents state that widget has landed at their bay, that's when you recognize revenue. Vice versa, if you purchase a piece of equipment, when that equipment lands at your bay, that's when you would recognize the liability or the time in which you need to pay those people. So here we're on the cash basis. Like I said, when you receive $1,000 in your bank account for doing a service for somebody, that's when you'll recognize the revenue. Opposing for the expense, whenever your check gets cashed, that's when you'll document the expense being paid. And same thing for computers as well. So it's every time an activity happens in your bank statement or in your checking account, that's when you record these activities. It's much simpler, especially for small businesses, to kind of keep track of, especially when there's not a lot of activity. And then this is the accrual basis. So again, when you perform the service, so accruals, it wasn't shown on the balance sheet that we had before, but there's also two aspects of a balance sheet for accrual accounting. You have payables and you have receivables. Those are the timing differences that are caused by accrual accounting. So in cash, it's easy to say, I paid this, it came out of my checking account or came into my checking account on this time on this day. In accrual accounting, you say it landed here, so I'm going to show that activity is being, that revenue is being recorded, but you haven't been paid yet. So there's a timing difference. And so in this instance, we have fulfilled our obligations. So we record our revenue, and then we put an asset on the books saying, well, we need them to pay us, so we have a receivable. When the client or customer makes that payment to you, what you do is you take that receivable and you move it up to cash. So now you've received the cash, so no longer do you have a receivable on the books. So it's a little bit more work than the cash basis of accounting, but I think the slide earlier said this is what most financial statements are based off of. So, you know, it's a little more accurate as far as being able to get activities within a period and getting a fair representation of, you know, how you've performed during that period. We have paid rent, again, rent expense, cash, and then purchase of computer, very similar. So if you're not doing this already, what you should do on a monthly basis is reconcile your bank statement. So for a cash basis, this is not something you really have to worry about. because you're just recording the activity for the most part as it occurs. Accrual basis is, I apologize, still going to be a timing difference. So when you write checks and they haven't been cashed yet, there's going to be a difference between what you have on your general ledger and what's in your bank statement. So what you have to do is you have to figure out what checks have you written that have not cleared the bank statement. You have not cleared your bank yet. And those become a reconciling item between your general ledger and your bank statement at the end of the month. And so there you get a bank reconciliation. So one of the biggest things to be aware of is that P&Ls give you a good bit of information, but they're also filled with things that aren't necessarily affecting your operational activities. So you have depreciation, you have debt payments. So depreciation is going to increase the expense on your profit and loss statement, whereas debt payments, and there's no cash activity that goes along with that, right? So you're not actually paying anything for depreciation. It's just one of those things that occurs and there's no cash activity related to it. Vice versa, when you have debt, your debt actually is reduced on your balance sheet. All you pick up is the expense portion of it. So when you pay down debt, you're actually paying money out, but that's not getting represented on your profit and loss statement. So using a cash flows is one of the most important things to understand operationally how you're performing. So the most important thing about anything that you use in the business world or even in your personal life is good inputs or good outputs, bad inputs or bad outputs. So retention of documents is very important. It allows you to go back and in organization of those documents, because being able to go back and answer questions or complete the full circle is very important. Electronically, generally speaking, is the best way to go about it. A big stack of boxes that have receipts from 3 years that aren't, matched to any specific year. It's very difficult for anybody to go through and do any kind of tax work. It also costs more, generally speaking, when you have poor document retention and organization. Recording methodology, we talked about this earlier. You choose the cash or the accrual method. Generally speaking, you choose one or the other, and you have to be consistent with it. You can't, mix and match how you go about your accounting approach. Cash reconciliation timely, is very important because it lets you know there might be a problem. If you wrote a check and it hasn't been cashed yet, maybe they didn't receive it. Or if there's things that are going through your checking account that you have no idea what they are, it will give you a heads up to investigate further. There's 2 ways to keep books. Well, there's not 2, there's several ways. There's tons of accounting softwares out there. For small businesses, generally speaking, the very small businesses, Excel can be utilized. It's not hard. It has the functions that you really need with little to no, with limited activity to be able to keep track of your books. QuickBooks is like the small business dream. Nearly every small business I know uses QuickBooks. It's fairly cost effective for small businesses, and it gives you a lot of added on benefits. So here's an example of utilizing an Excel schedule. You'll see these are the activities throughout the year or through the month of January. And on the right-hand side, you'll see the P&L activity. So it basically sums up your revenue streams and then itemizes the different expenses you've had in that month.
And I think one of the important things, and a lot of small business owners get caught up, is what types of expenses do you have? And either they have, most of their expenses classified as miscellaneous, which doesn't really tell you a whole lot, or they get into such a granular level that maintaining that level of granularity is difficult. So one of the questions that we had was, how would we go about maintaining a difference between items that are recorded for a not-for-profit entity versus a for-profit entity? And my advice would be to set up your chart of accounts, meaning the accounts that you're using: cash account, your sales revenue, grant revenue, dues expense, rent expense. You want to make sure that the expense types and the revenue types that you have are appropriate for getting an accurate picture of what is actually happening in your business.
And like to go further with what Chris was talking about, I have clients that have a lot of grants, and a lot of grants with different entities and organizations and stuff like that. So what they use is coding by numbers. So in their coding structure, they'll have something that identifies this grant being both a revenue and expense. So they know going forward that call it 40020, right? So everything 4020 is revenue, and everything 5020 will be the expense related to that grant. So there will be corresponding accounts that they can refer to as far as what activity is being done. QuickBooks, like the slide says, it's the ultimate accounting software for small businesses. I am on a small board, and right now I'm paying $200, I think, a month for QuickBooks Pro, and there's tons of features in there. The bank recs is very, very. Also, I don't get paid by QuickBooks, but this is just this is not advertisement, just my own personal opinion. They have seamless interaction with your bank for the most part, as long as you bank with a pretty good bank. So you can link your bank accounts, you can link credit cards, they'll help you with payroll. So for small businesses, this is kind of a one-stop shop. There are a few things that don't lend itself to being quite user-friendly, but still at the end of the day, it's kind of, for small businesses, your best choice. As slide says, you can perform bank reconciliations fairly quickly. Import credit card, you actually don't even import, you link it to your account. So there's you click a button, and there's not a whole lot of technology you really need to click a button, and then it will bring all of your credit card activity and your bank activity into QuickBooks. And then you just go ahead and you will categorize it as you see fit. And then the function for reporting, you can do tax reporting, you can do payroll reporting. If you run payroll through QuickBooks, you can also do any kind of bank reports that you need as well. All your bank reconciliations are stored there.
And another thing that I think is important is to make sure that you don't get bogged down with the methodology that you're using. You want to make sure that it's giving you, the business owner, the information that you need to run your business. And so, periodically, ideally monthly, you're reconciling your cash, you're paying attention to your profitability. How much are your costs? Are you paying too much in salaries, or the materials that you're buying, the inventory? Are you not paying attention to how much you're making on each item? If you're selling, if you sell it for $5 but you're buying it for $6, you want to obviously be aware of that, and those are the types of questions that a good accounting system is going to answer for you.
And other financial reporting to that point, Chris, is you can set budgets, annual budgets in QuickBooks, and you can run budget to actuals to see how you're performing based on where you thought you would be performing. You can run quarterly reports in comparison, so you can see Q1, Q2, Q3, how did we do? How are they in comparison to what we did in other quarters. So there's tons of options out there to kind of break down your business in many different manners and try to analyze the information that comes out.
So I'm going to talk to you a little bit about compliance and taxes. Obviously, income taxes are what a lot of business owners are concerned with, and income taxes are a variable cost. So unfortunately, if you are an extremely profitable business, you are going to pay income taxes. And we'll talk a little bit about how to go through that and how to minimize the amount of taxes that you're paying. But taxes are a cost of business, and we can help you plan for how to minimize it. But overall, if you're a profitable company, you're going to pay income taxes. And there's a number of other different taxes that a small business is going to be concerned with. Payroll taxes if you have employees, sales and use taxes, and all of those taxes are important that you're cognizant of them, because you don't want to run afoul of Maryland or the IRS. And you're not paying it, and you're not paying the taxes that you need to be paying. So I'm not going to get into a whole lot about the payroll taxes and sales and use taxes today, but I can certainly answer questions at the end if anybody has them. But we'll be focusing mostly on the income taxes. And income taxes are, like I said at the beginning, they're going to be fairly similar across the entity types, but the administration of the tax process is going to be slightly different depending on how the business is organized, whether it's a sole proprietorship, a partnership, pass-through entity, or a corporation. So for a small business, you're going to pay two different types of taxes. You're going to pay an income tax, and if you're a sole proprietor or a partnership, you're also going to probably pay some self-employment taxes. And income taxes are going to be based on how much money you earn and your marginal tax rate, and I'll go through an example of that. But for a lot of people, they've never heard of self-employment tax. And what self-employment tax is it's basically a substitute for Social Security and Medicare taxes, and it gets money into the federal government so that when the business owner retires, they're eligible for the Social Security and Medicare benefits that the IRS has established for them. And in general, if an expense is deductible for one type of entity, it's going to be deductible for all of those types of entities. There's not a whole lot that a sole proprietor can deduct that a partnership or an S corporation can't deduct. Most of the differences are related to owner compensation and equity or ownership related to the business. Some important deadlines that you need to be paying attention to. Unfortunately, we have them coming up very, very soon. March 15th is the pass-through entity original tax filing deadline. You can get an extension through September 15th if you're a partnership or an S corporation. And April 15th is the individual income tax filing original deadline. We can, again, get an extension for filing that. But one of the misconceptions that a lot of people have is that they can pay the taxes by the extended due date, and that is not correct. An extension, if you need an extension, is to file the paperwork. You don't know how much revenue you had, you don't know exactly what your expenses are, and you're not going to know that by April 15th. And so you file an extension to get that paperwork sorted out, but the tax that is due by April 15th. It does not extend the date that the amount is paid. So right now I'm gonna go through an example of how the tax is calculated. The first thing that you need to understand is what is taxable income. And taxable income is basically what are your revenues minus your expenses. And so more deductions reduce the taxable income. But one of the questions that we had is when can they hurt your business? And as Kevin said, cash flow is probably one of the most important metrics that you as a small business owner are going to be paying attention to. And you don't want to have the tax tail wag the operations dog. You don't want to have a lot of expenses to reduce your taxable income, reduce your income taxes when it doesn't make business financial sense. And so the answer to the question that we got, when are too many write-offs hurtful, is when you're not paying things that you should, when you're paying for things that are not making sense in your business. Ideally, you want your business to be profitable, but you don't want to have tax motivated reasons for paying for things, because at the end of the day, it's cash out of pocket. So your taxable income, as I said before, is your revenues minus your deductions, and the tax brackets work in the following way. And so there's various tax brackets depending on your filing status, whether you're filing single or married, filing jointly, or head of household. There's a number of different filing statuses. But whatever filing status you have is going to determine what your marginal income tax bracket rate is. And so the first bracket is, I think this is for a single individual. The first bracket is the 10% bracket. And if you make between $0 and $9,950 in a year, you're going to be solely in the tax bracket, in the 10% tax bracket. If you make $10,000 in a year, if you have $10,000 of taxable income, that entire $10,000, even though you're in the 12% bracket, is not subject to 12%. So the first $9,950 is subject to the 10% bracket, and that extra $50, it flows over into the 12% bracket. So only $50 of that $10,000 of taxable income is subject to 12%. I think that's like $6 or something like that. So sometimes there's a misconception that you don't want to make more money because you'll be in a higher tax bracket, and that's not the way that it is. You never want to turn down a raise because you're going to pay more taxes. So this is an example, and the numbers are a little screwy because taxes are sometimes using odd rates, but they are the way that it'll be clear why they are what they are in a moment. So for example, let's say you have sales revenues of $150,000, and all of the expenses that you have, your cost of goods sold, materials, insurance, rent, they're about $78,000. So if you take 150 minus 78, you get a net income of $71,000, $71,840. From that $71,840, we're going to take a couple of other deductions. The first is we get a deduction for half of the self-employment tax that we pay. We get a standard deduction based on whatever your filing status is, the single, married, head of household. And then as a small business owner, you also are able to take a deduction for qualified business income. And that's a relatively new concept that came into effect when President Trump passed a tax law probably about 4 years ago. And so if we take all of those deductions against our net income of $71,840, our taxable income is $40,525. And why that number is important is that it is the very end of the 12% bracket. And so we filled up the entirety of the 10% bracket, and we pay 10% of $9,950, which is $995. And we pay $3,669 because we filled up the 12% bracket as well. So our federal income tax is $4,664, but we also have a self-employment tax obligation. And that's actually what a lot of self-employed individuals have more than income tax obligations, is self-employment. So between the income tax, federal, and the self-employment tax, you're looking at a tax bill of about $16,000 in this scenario.
Chris, I just want to point out we're at about 12:45 almost. Okay.
Well, thank you very much. Almost finished. So again, I tell a lot of my clients this: you don't want to pay for things that you don't need to in your business. Cash flow is the most important thing. If you are motivated by taxes, the best way to to reduce the amount of taxes that you pay is to make less money. The second best way to minimize the taxes that you're going to pay is to take advantage of the tax deductions that are available to you while still making business, financial, and operational sense. So you want to make sure that you're spending efficiently and effectively. You want to make sure that you're investing in the equipment that you need to run your business, and retirement plans, 401k plans, self-employment, SEP plans. There's a lot of different retirement benefits that you can set up in your business, so that once you're done working, you'll have those funds available, and there's definitely tax benefits associated with those. So what is a CPA? What do Kevin and I do all day? We do audits and taxes, and so I help business owners and companies stay compliant with business with tax rules. A lot of times, if you get a loan from a bank, they're going to need an audited financial statement. Gross Mendelsohn performs those services, puts those together. The basis of both the income taxes and the financial statement is your accounting system. So the more organized you are and the better your accounting system is, the easier compliance will be with the governments and your bank covenants and those sorts of things. And I talk with my clients all day about what are the rules, what can we deduct, what makes financial sense, what are the trends, how do I make more money, all those different sorts of things. And we as CPAs are very versatile and see a lot of different scenarios and can help you with a lot of those questions. And that is the conclusion of our presentation. I hope that we answered a lot of the pre-submitted questions. One of the things that came in there were a couple of questions about benefit corporations, L3C companies, and I don't personally, I haven't worked with any of those. I asked a couple of my coworkers. Gross Mendelsohn doesn't seem to have a whole lot of experience with those. So unfortunately, I'm not able to answer a lot of questions about that.
Chris, let me suggest, and Kevin, I'd like to quickly run through some of the questions in the chat, and if you would try to the best of your ability to limit answers, maybe to be as concise as you can. Let's try to work through. Okay. One question in the chat is, will you talk about LLC versus S Corps? How do we know which one to choose?
There's not a ton of difference between them. They're both separate entities. They're both pass-through entities. The difference comes in compensation. So owner compensation, the main difference comes in owner compensation. But there are not a lot of people who regret making an S Corp election versus organizing an LLC. And I think that's probably something that we can talk individually about, but there's really not a ton of difference between the two entity types.
Okay. Why would a business choose either cash or accrual accounting?
So one of the things I realized when I was talking earlier about cash accounting is that I referenced your bank statements when you should be reporting transactions. It's actually when you write the check, mail the check, and receive the check and deposit the check. Those when you should record those transactions. So I just want to clarify that quickly. The other thing is cash allows you to simplify. So if you don't have a complex organization where you're constantly have things outstanding, whether it be liabilities or revenues, cash is probably the easiest approach. If you have a more elaborate business model where you're constantly have 30-day, 90-day agreements with customers, it's much easier to track who owes what to you and who you owe things to than the cash method of accounting, because it puts it all together on your balance sheet. The one good thing that I like about it, the accruals, is that it brings everything that you've done in one time period together, where the cash method of accounting doesn't necessarily do that.
Is there an organizational map for multiple locations depending on structure? For example, if an S Corp gets additional locations, what does that look like?
So this kind of adds on to one of the other questions about a holding company. So there's ways to do it. So you can, a structure for a multiple location would be the same as it would be a single location. But to Chris's earlier comment about protecting yourself with LLC or an S Corp, each location could be its own S Corp. And then you would be limiting your liability to just that one location. So if you had 3 locations, you would have 3 S Corps. If they're all owned by the same company, then you would create a holding company, which all of the income and expenses and all the ownership would roll up into that holding company. So I think that might have killed 2 birds with 1 stone.
Very good. In QuickBooks, what reports should I be running to give to my accountant for tax time?
So the main ones are your trial balance for the year and your general ledger for the year. That's like the basis of all tax work. You can also run payroll reports if you run payroll through there as well. But a lot of it is based solely on your what you want to see as a business owner.
And I always find it funny that in QuickBooks there's a tab called Accountant and Taxes, and those are all the those are all the reports that I like to see: accountant reports, P&L, general ledger, trial balance.
Yeah, if you're on the accrual basis, also you want to provide receivable, aged receivables and aged payable reports.
How long should I keep business tax and financial documents?
So the statute of limitations for the IRS is 3 years. I usually, if everything is properly reported, I usually recommend that as a minimum 5 years to keep supporting documentation. If there's fraud, or if a company has not filed tax returns, the statute hasn't begun, and so you need to keep all of those records.
Can you comment on the trade-offs involved sometimes between reporting low income for tax purposes versus qualifying for a loan?
That's a rub. The bank is going to be asking for your financial documents to make sure that you have the capacity to repay it. And so in that capacity, in that scenario, you want to be as profitable as you can. But again, taxes are a cost of doing business, and a lot of bank representatives understand what's going on. And so if you're unprofitable for 1 year, but you've been profitable historically, they'll usually understand that. But you may need to provide some context about that.
And we talked together, and this is really for kind of a joint Gross Mendelsohn and Innovation Works question. Can we talk together about if an accountant is needed, can they reach out directly to you, and or what would you suggest? And I can answer for Innovation Works. I think, what would we suggest about people that need an accountant? And for our part, I want to say for Innovation Works, this is not particularly a sales presentation. In other words, if someone on the call chooses and wants to reach out to Gross Mendelsohn, that's absolutely fine. If you would like to reach out to me or to us directly, that's fine too. And our typical practice, my typical practice would be to recommend several options to you for accounting. So it's not about sales, it's about who is the right fit and who do you really choose to work with? And Chris or Kevin, could you comment on that as well?
Sure. So, it's all kind of who you can afford and who you feel most comfortable with. We are not the cheapest game in town, but we come with a lot of added benefits that may or may not be useful to you as a business owner. So if as John said, I would interview multiple people, reach out to multiple people, and the one you feel most comfortable with, I would choose them. Price, operations of your business is very important. So if the person you like is not in your cost equation, then you have to move on. But I think being comfortable with your tax accountant is one of the most important things that you can have. We look to be a trusted advisor to our clients. So that's in my opinion.
And I would say this as a former banker, I think a good goal would be for any business owner to have a small circle of trusted advisors, and that would include an accountant. It would include maybe an attorney. It would include, other people that know you and that you trust. And of course, there's a cost issue involved, and you don't want to overpay. But at the same time, often I think what happens is small businesses choose the cheapest possible service and they lose out on the value of a trusted advisor. So we're open to further dialogue about that. We're a couple minutes before 1 o'clock. Chris or Kevin or Jay, if you're still on the call, would you like to make any comments to close us out?
I just wanted to say we really appreciate the invitation to speak with you today. This is something that I really enjoy talking about. I like the reason that I got into this career is so that I can help people with money issues. I understand that a lot of the times this arena is daunting. It's overwhelming. I really don't know where to start. And the part of being a CPA that I enjoy and working for a public accounting firm is that I help people with their money problems.
Okay. I just want to thank everyone for your time and joining us today. And as John said, if you have any questions, please don't hesitate to reach out to us.
Nothing to add from me, just gratitude to everyone for being here.
Good. Thank you very much, Jay. All right. Good day to all. We really appreciate the time and look forward to continued work together. So
thanks a lot.
Have a good day.
Thank you.
Thank you so much. I appreciate it.